Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Waystar Holding Corp. Annual Report. Waystar Holding Corp. offers a comprehensive suite of cloud-based software solutions tailored to the healthcare industry's unique needs. At its core, the company provides financial clearance and patient financial care services, ensuring seamless payment processing for medical providers. The platform also excels at claim and payer payment management, streamlining the often complex process of navigating insurance claims and payments. Additionally, Waystar's solution helps prevent denials and recover lost revenue, minimizing financial losses for healthcare organizations. Furthermore, the company provides clinical integrity and revenue capture services, ensuring that medical providers are fairly compensated for their services while maintaining the highest standards of care. Analytics and reporting solutions round out the platform, providing valuable insights to inform business decisions and drive growth. Overall, Waystar Holding Corp's offerings cater to a wide range of healthcare industry needs, making it an essential partner for medical providers seeking to optimize their financial operations. The stock price of Waystar Holding Corp. has experienced a significant decline of over 36% in the past year, with its 52-week high reaching $48.11 and low at $21.45. Several news events have contributed to this drop. One major factor is the concern about AI disruption in the sector, which led to a sell-off of more than 30% since Freedom Capital Markets initiated coverage in November 2025. This sustained downward pressure continued into early 2026. Analyst price target reductions also played a role, with multiple financial institutions lowering their targets for Waystar in February 2026. Citigroup cut its target to $35, while Truist Financial reduced its to $38, and Citizens adjusted its price target from $48 to $34 due to broader multiple compression within the software sector. Bearish options activity around the fourth quarter 2025 earnings report further amplified downward pressure on the stock price. Despite reporting strong results with revenue growth and raised 2026 guidance in February 2026, the stock still reacted negatively due to a combination of these factors. Waystar Holding Corp. Market capitalization of $5 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Waystar Holding Corp. holds a significant advantage in their industry. Waystar Holding Corp. trades at a higher price-to-earnings ratio of 40 times and a lower price-to-book ratio of 1.29 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 33% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of financial reports and statements. Acquisitions have been a significant contributor to revenue growth for several companies, with notable examples including the acquisition of Iodine on October 1, 2025, which added $31 million to consolidated total revenue in 2025. Subscription-based services are another key driver of revenue growth, accounting for 99% of total revenue in one company's report. Volume-based revenue has also been a major contributor, with an increase of $54.8 million from 2024 to 2025 reported by one company. Implementation fees and hardware sales have also played a role in driving revenue growth. In contrast, changes in cost of revenue and general and administrative expenses have affected revenue growth or decline for some companies. Interest income and related party transactions have had varying impacts on revenue from year to year. Overall, the data suggests that acquisitions, subscription-based services, and volume-based revenue are key drivers of revenue growth, while changes in costs and interest income can impact revenue decline. The net income of the company underwent significant changes between 2022 and 2025. Initially, it decreased from a loss of $51.5 million in 2022 to a loss of $51.3 million in 2023, indicating minimal improvement. However, by 2024, the net income remained relatively stable at a loss of $19.1 million compared to the previous year. The most notable change occurred in 2025, when the net income increased significantly from a loss of $19.1 million to a gain of $112.1 million. The profit margins also experienced fluctuations during this period. Initially, they decreased due to higher costs and reduced revenues. However, by 2025, the profit margins likely improved due to reduced stock-based compensation expense and acquisition costs compared to 2024. The reasons for these changes can be attributed to various factors, such as reduced revenues in response to changes in the healthcare regulatory landscape, increased card network fees, asset impairment charges, and general macroeconomic conditions. Additionally, the company faced challenges like an iodine acquisition and a cybersecurity incident response, which may have contributed to the fluctuations in net income and profit margins. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the provided data, the net cash provided by operating activities has been steadily increasing over the past 3 years. In 2023, the company generated $51,460 in positive operating cash flow, which increased to $169,768 in 2024, and further rose to $309,673 in 2025. This upward trend suggests that the company's operations are becoming more efficient and profitable, resulting in a significant increase in cash generation. The confirmation on page 104 also supports this conclusion, reiterating that the company is indeed generating positive operating cash flow. Overall, these figures demonstrate a strong financial position for the company, indicating its ability to sustain growth and meet its financial obligations. The company's debt level has undergone significant changes over the past year. Initially, the debt was $1.17 billion, with an increase of $250 million on October 1, 2025. However, by the end of 2025, the total liabilities had increased from $1,497,218 to $1,906,274. This represents a substantial rise in debt level. In contrast, interest expenses have shown mixed results. While there were instances where interest expenses decreased, such as a 47% drop from 2024 to 2025, other periods saw no significant changes or even an increase. For example, interest expense increased by $2.1 million from 2024 to 2025 in one instance. Overall, the company's debt level has increased significantly, while interest expenses have been inconsistent. The management of the company is optimistic about its outlook and strategy, with a focus on driving growth through strategic acquisitions and investments in research and development, R&D. The company's revenue model is primarily subscription-based, with contracts typically lasting 2-3 years, providing a stable source of income. To mitigate risks, the company has implemented strategies to manage interest rate risk and cash flow management. The company's strategy also involves investing in R&D to maintain its product leadership and reputation, which is essential for growing its client base. Additionally, strategic partnerships with companies like Bain Capital LP indicate a long-term commitment to working together. However, there are some uncertainties and risks that need to be addressed, including dependence on macroeconomic conditions and uncertainty around future capital requirements. Overall, the company's management appears confident in its ability to execute its growth strategy, but acknowledges the importance of managing risks and uncertainties to achieve long-term success. The company's financial history reveals a consistent trend of not distributing profits to shareholders through dividend payments. Despite generating significant revenue, the company has chosen not to reward its investors with dividends. Furthermore, the company has also refrained from buying back its own shares, indicating a focus on other areas of investment and growth rather than shareholder value creation. That concludes the financial summary for Waystar Holding Corp. Feel free to comment below, and I will be happy to answer them when possible.